Welcome back to my channel borisnomics. For the first time in history, oil price has gone negative. On Monday 20th of April, West Texas Intermediate for May delivery was trading at low as minus $40 per barrel. To understand what's going on, we need to be clear on what drives the oil market, the different types of oil products, and the financial derivatives of these oil products. So, in this video, we will look at 1. The dynamics of the oil market in relation to the economy, and 2. The structure of these derivatives. Now, demand. Economic activity consumes energy, and oil is one of the most important sources. Driving your car, flying planes, but we can't use crude oil straight off the ground. They're first refined into petroleum, gasoline, and the like. Different types of end products come from different types of crude. The two major benchmarks of crude are West Texas Intermediate, which is lighter for petrol, and Brent crude, which is heavier and used for diesel refinery. Now, these prices often go in locksteps with one another. Now, supply comes from countries which have got these reserves deep underground. The biggest producers are the US, Saudi Arabia, Russia, followed by Iraq and Iran. Their production capacity greatly influences oil prices. In 1973, the OAPEC proclaimed an embargo targeting countries seen as supporting Israel, and oil price quadrupled. In 1979, the Iranian Revolution suppressed production and oil price doubled again. In 2020, the price war between Saudi Arabia and Russia, on top of the already weak demand during the COVID-19 pandemic, more than halved oil price in March. Oil supply is sensitive to geopolitical events and imperfect competition because oil is such an unevenly distributed resource across a planet. Big producers heavily influence the revenue other oil producing countries are making. If all producers can get into a room, for instance, and agree to cut production, they will all benefit from high prices. But then there is always the temptation that when everybody else cuts production, I don't follow and profit from selling more at high prices. So in economic terms, if this oil game is played once, everyone cutting production is not a Nash equilibrium, since countries gain from not following production cuts. A Nash equilibrium is a state where no player gains from deviating. So the only way organizations like OPEC can sustain any production deal is because the oil game is a repeating game and reputation is important. But back to the negative price story, it's not enough just to look at the supply and demand of energy use per se, but also 1. The transaction cost, and 2. To look at the financial derivatives of oil. Now, transaction cost, Brent crude, for example, is offshore, meaning barrels can be put on ships immediately after drilling for sale or even left for storage on sea. West Texas Intermediate, or WTI, on the other hand, is produced inland and piped through to Cushing, Oklahoma for storage. So when countries refuse to cut production significantly and oil consumers are not taking these barrels physically away, investors have to have storage in place. And storage in Cushing is getting full. Yes, some investors have leased extra storage to bet on oil price recovery. And even though WTI went negative, Brent crude was still trading at about $20 per barrel. But 2. Financial derivatives of oil. Perhaps more importantly, oil price turned negative because of how financial derivatives are structured based on benchmark oil prices. You have companies buying the physical oil, but you also have funds buying oil futures. Now, future came into existence after the 1970s oil crisis and helped companies like airlines stabilize their fuel costs. Instead of buying spot oil in 2 weeks' time, which can lead to large swings in price, they can lock price in for delivery by buying futures. Delivery comes in every month, a few weeks after the trading deadline for the month. So WTI contracts for May delivery expired on the 21st of April. For June delivery expires on 19th of May, and for July delivery expires on 22nd of June, and so on. Now, trading stops after the deadline, and oil will be physically delivered to whoever holds the futures then. When investors realized they don't have storage or customers who want them, they started dumping the ones for May delivery. They were essentially paying those who can store the oil to take it off their hands. Now, a lot of the funds also bet on the oil price movements using futures. These exchange traded funds or ETFs speculate on these derivatives. When oil is sought after, they can hold these futures until close to deadline and sell at a profit. But when delivery for front month, term for nearest expiries, is actually cheaper than the next, which is what we're seeing, the oil industry call it forwardation or contango. That means if the ETF just wants to hold the same amount of oil futures for the month, it has to sell the front month at a lower price and buy them back for the next month at a higher price. This is called rolling the contracts and represents a cost itself to just holding the portfolio. Now, a lot of investors bet on oil price recovering without realizing the cost of holding these futures in the meantime. That means oil price can double in a year and the ETFs still make a loss because of the cost of holding on to these oil futures. So let's do a summary here. WTI for May delivery went negative for the first time in history during the COVID-19 pandemic. Trading oil as a commodity is not the same as stocks, and futures expire every month for actual delivery. And if you want to hold on to oil, you need to roll the contracts every month. ETFs can lose money in a contango or forwardation when next month's futures are more expensive than front month. Brent crude is easier to store than WTI and hence was still positive trading, but trading at a discount. Most people don't physically trade oil but trade ETFs which hold oil futures off the back of physical oil. Thank you so much guys for watching this video. If you like it, please like it and subscribe to my channel borisnomics, and I'll see you in the next one. Bye!